Welcome to the Explainer. Today, we're going to cut right through the fantasy to expose the staggering and honestly kind of mind-blowing reality of what actually happens if someone hands you a gold mine tomorrow, especially with gold sitting near its highest price in human history at around $4,000 an ounce.
Okay, so picture this. You just found out you inherited a massive piece of land, and it is absolutely packed with gold. The market price is at a record high, so you're basically a billionaire overnight, right? Well, the honest answer is maybe, possibly. But it really depends on a set of variables so intensely complicated that even some of the most experienced mining executives on the planet have gotten them catastrophically wrong.
First things first, we need to instantly shatter the whole Hollywood myth. Modern mining isn't about stumbling across buried treasure chests or just picking up heavy, shiny gold nuggets off the ground. Not even close. It's actually an unforgiving, massive industrial equation where you're trying to extract microscopic flakes locked inside billions of tons of solid rock. Seriously, you could spend years searching this rock with your bare hands and never see a single flake.
So to understand this, let's define what is arguably the single most important number in the entire industry. It's called the ore grade. Gold is measured in grams per metric ton. To get just 1 ounce of gold, which is roughly a coin-sized piece of metal weighing about 31 grams, you might have to literally blast apart, haul, crush, and chemically process anywhere from 30 to 300 tons of solid rock. This baseline grade completely dictates whether your newly inherited mine is worth anything at all.
And the contrast here is just staggering. Most average mines have to do complex, razor-thin math every single day just to survive on 1 or 2 grams per ton. But a once-in-a-generation discovery changes everything. Take Australia's Fosterville mine, for example. In 2015, they hit a zone averaging over 44 grams per ton. That grade was so extraordinarily high, it drove their production costs below $400 an ounce. It transformed them into a billion-dollar business basically overnight. So, let's dive into the first hurdle, the cost of finding gold. Let's say a dusty old report in a filing cabinet estimates your new land holds 3 million ounces sitting right there in the ground. Well, you can't just go out and grab a shovel. You need permits, and that takes a lot of time. In Australia, you're looking at 3 to 4 years. In Canada, 5 to 7. In the United States, it can be 5 to 8 years. And during this entire waiting period, you are paying for environmental consultants, engineering firms, legal teams, community liaisons. Millions of dollars are going out every single month, and you have absolutely zero revenue coming in. And actually, even before permitting, you have to definitively prove the gold is down there through exploration drilling. Historically speaking, it costs an average of $62 just to find a single ounce of gold. Think about what that means. You could spend $50 million drilling 1,000 meters straight down into hard rock over a couple of years, and guess what? You might find absolutely nothing usable. If that geological gamble fails, there are no refunds. That $50 million is simply gone.
Which brings us to phase 2, building a billion-dollar mine.
Okay, let's assume your drilling actually worked out and your permits cleared. Huge win. Now you have to fund and construct what is essentially a remote mini-city. Building a modern mine requires staggering upfront capital. We're talking engineered haul roads that can support 400-ton trucks, independent power grids, massive water treatment systems, employee housing, medical facilities. Barrick's Gold Rush project in Nevada carries a capital budget of right around $1 billion. And remember, all of this has to be paid for before you sell your first ounce of gold. Just to give you an idea of the scale, the processing plant alone is a monumental expense, mostly driven by its massive energy demands. They use these giant rotating cylinders filled with heavy steel balls to crush the rock into fine powder. These grinding mills are absolute beasts. They consume somewhere between 40 and 50% of the plant's total electrical power. The infrastructure required just to keep the lights on is mind-boggling. So you're probably asking, how on earth do you pay for a billion-dollar construction project before you're making money? Welcome to the early financing trap. If you take on $1 billion in debt at a 5% interest rate, you owe $50 million a year in interest alone, and that's even if construction gets delayed. Alternatively, you might sign a streaming agreement to get upfront cash. But the catch is, you're forced to sell a percentage of your future gold output to that financer at a massive discount, sometimes as shockingly low as $400 an ounce. Every single ounce you sell for $400 is an ounce you permanently lose the chance to sell at that $4,000 open market price.
Okay, moving on to part 3, the daily cost of digging.
Once the mine is actually built and fully operational, the massive expenses don't just disappear. They become this relentless daily reality. Just to maintain one ultra-class mining truck, which by the way is a vehicle the size of a two-story building that already cost you millions to buy, you have to regularly replace the tires. The abrasive rock absolutely destroys them. A single set of 6 replacement tires will run you up to $450,000 every few months. Multiply that across a fleet of 60 trucks, and your tire budget alone is the size of a successful medium-sized business.
And those relentless costs just keep compounding. A single large truck can burn through nearly 1 million gallons of diesel in a year. When global oil prices spike, your costs spike automatically. Then you're constantly replacing those worn-down steel grinding balls, the cyanide, and the carbon needed for chemical processing. And we can't forget labor. You're likely chartering flights for specialized workers in and out every 2 weeks. In 2025, U.S. mining wages rose over 8% in a single year. That adds tens of millions to your operational costs, without adding a single extra ounce of gold output.
So how does the industry track all this financial bleeding? They use a standardized metric that was introduced back in 2013 called the All-In Sustaining Cost, or AISC. Basically, it calculates every single direct and indirect cost required to produce 1 ounce of gold. By 2024, the average AISC in the United States had climbed to over $1,716 per ounce. That means even if you do everything right and find the gold, your profit margins are constantly, relentlessly under pressure.
This leads us perfectly into Section 4, the profit and risk equation.
This is the trap at the very center of your new mining empire. Your costs are mostly fixed, things like your truck payments, labor, diesel, but your revenue relies entirely on global financial markets that you have absolutely no control over. In a massive boom market with gold at $4,000, both a highly efficient mine and a struggling mine look incredibly profitable. But if prices drop back down to historical norms around $1,200 an ounce, the good mine barely breaks even, and that struggling mine goes completely bankrupt. The math simply stops working. And make no mistake here, even the biggest, most well-funded players get this catastrophically wrong. Back in 2015, a company called Rubicon Minerals built a massive mine. But when they finally got underground, the gold simply wasn't where their surface models had promised it would be. They lost 88% of their resources on paper and failed. Or look at the industry giant Barrick. They saw costs on their Pasco Lama project balloon from $3 billion to $8 billion due to regulatory and environmental disputes. It ended in a devastating $5.1 billion write-down on a single project.
And finally, we arrive at Part 5, the multi-billion-dollar cleanup.
We've officially reached the final chapter of your inheritance. And it's the part almost nobody imagines when they dream of gold. Eventually, the gold runs out, or the math just stops working. And when that happens, you can't just lock the front gate and walk away. You are legally obligated to restore the land. Take the Yellowknife giant mine in Canada, for example. When that mine closed and its operator went bankrupt, it left behind an absolutely staggering 237,000 tons of highly toxic arsenic dust stored underground. That arsenic is so dangerous, it must be kept permanently frozen. And I don't mean for 10 years or 50 years. I mean indefinitely, just to prevent it from leaking into the water supplies. That single remediation project became the burden of everyday taxpayers, costing an estimated $4.38 billion. Because of nightmarish disasters exactly like this, modern regulators now force you to post massive, dedicated financial bonds that guarantee you can cover your closure costs way before you are legally allowed to dig your very first hole.
So what's the ultimate takeaway from this explainer? It's that owning a gold mine isn't really about finding gold at all. It's actually about managing a ruthless, unforgiving equation of capital, ore grade, risk, and fixed costs, all balanced against wildly volatile global markets. The richest mine in the world isn't the one with the most gold in the ground, it's the one that can consistently dig it out for less than what the market pays. If someone handed you the keys to a gold mine tomorrow, do you honestly think you could survive the true economics of gold?